This video is different from the others. There is no new theory here. Every concept you need, you already have. What this video does is take all of it: direction, strike, expiry, premium, the chain, the Greeks, and run a single complete trade from the first thought to the final exit. We are going to trade Apple. Step by step. Real numbers. Real decisions. Every choice explained. By the time this video ends, you will have watched a full options trade play out, and you will know exactly how to repeat the process yourself. This is not a simulation. This is the exact workflow a trader uses every single time they open a position. Video 1 through 6 was the toolbox. Video 7 is the trade. Step 1. Market context. Before any options decision, you need a reason to be in the trade. Not a feeling, a thesis. Here is the setup for this trade. Apple is trading at $182.50. The broader market has been recovering for 3 weeks following a rate decision. Apple has pulled back from a recent high of $196 on general market weakness, not company-specific bad news. The next earnings report is 8 weeks away, well outside our trade window. Implied volatility on Apple is 22%, close to its 12-month average of 21%. No earnings volatility premium is inflating the options. The thesis: Apple is oversold relative to its recent range. The macro headwind is fading, and the stock is likely to recover toward the 190 to 195 range over the next 4 to 6 weeks. That is the thesis. Now we build the trade around it. Step 2. Direction. The thesis is bullish. You expect Apple to rise. The instrument is therefore a call option, not a put, not a spread, a single call. This is the first and most important decision, and you made it in video 2. Call equals up. The thesis tells you the direction. The direction tells you the instrument. Everything else, strike, expiry, size, is calibration around that core decision. One thing worth noting here: you are not certain Apple will rise. No one is ever certain. What you are doing is expressing a probability-weighted view with a defined maximum loss. If you are wrong, you lose the premium you paid, and nothing more. If you are right, the trade pays multiples of that premium. That asymmetry is why options exist. The call is the right instrument for a bullish thesis with defined risk. Step 3. Strike selection. The thesis expects Apple to move from $182.50 toward $190 to $195, a move of approximately $7 to $12. You are not predicting an exact level. You are positioning for a directional move with a clear price range. Applying the framework from video 3, your conviction is moderate to high, and you expect a meaningful move, not just a small drift. That points to a slightly out-of-the-money strike, not a deep out-of-the-money lottery. The 185 strike is $7.50 above the current price, a move of 4.1%. Apple making a 4% recovery from an oversold pullback is well within the thesis. Strike selected, $185. Delta will be approximately 0.42, a 42% approximate probability of finishing in the money. That matches the conviction level of the thesis. Step 4. Expiry selection. The thesis is based on a macro recovery and a stock rebound, not a specific catalyst event. The expected time frame is 4 to 6 weeks. Applying the framework from video 3, a medium-dated expiry of 30 to 60 days. You want enough time for the thesis to develop with manageable theta. 45 days to expiry, the next standard monthly expiry, is the right choice. It gives 6.5 weeks for Apple to make the move. Theta at 45 days is approximately 7 cents per day per share, manageable. If Apple rises in the first 2 weeks, theta has not done significant damage. If Apple takes 4 weeks to move, you still have over 2 weeks remaining for the position to gain further. Expiry selected, 45 days. Strike, 185. Direction, call. The structure is defined. Step 5. Opening the chain. You open the Apple options chain, select the 45-day monthly expiry, and navigate to the call side. Locating the 185 strike, bid $3.80, ask $4.20. Mid-price, $4 even. Spread, 40 cents, 200 basis points on a $4 option. On Apple, this is standard for a 45-day option. Acceptable. Volume, 1,412 contracts today. Open interest, 3,892. Highly liquid. No concern about getting in or out at a fair price. Implied volatility on this strike, 22.4%. Right at the historical average, you are not paying an elevated volatility premium. The chain confirms everything you need. Contract, Apple 185 call, 45 DTE, at a limit of $4 even. Step 6. Greek check before entry. You pull up the Greeks for the 185 45-day call. Delta, 0.42. This is in the sweet spot. You are getting meaningful directional exposure without overpaying for a deep in-the-money contract. The 42% probability of finishing in the money is consistent with your moderate to high conviction thesis. Gamma, 0.03. At 45 days, gamma is modest. Your delta will not shift dramatically day to day unless Apple makes a large move. Theta, negative 7 cents per day. On a $4 option, that is 1.75% daily decay, well within the acceptable range. Vega, 0.14. A 1% 4 change adds or removes 14 cents. With 4 at its average, Vega is not a significant concern here. All 4 Greeks are in acceptable ranges. The trade passes the benchmark check from video 6. Step 7. Implied volatility check. This is the final check before placing the order. Apple's at-the-money implied volatility is 22%. The 12-month average is 21%. The 12-month range is 15 to 32%, 15 during calm periods, 32 around earnings. At 22%, you are entering near the historical average, not an enforced spike, not at a volatility low either. The Vega on your position is 0.14. If 4 rises 2%, which could happen if the market becomes uncertain, your position gains 28 cents from Vega alone on top of any directional gain. If 4 drops 2%, you lose 28 cents, but you have 45 days for the directional move to compensate. 4 is not a concern at current levels. The position is sized correctly for the environment. Place the order. Step 8. Placing the order. You open the order ticket. Option type, call. Underlying, Apple. Strike, $185. Expiry, the 45-day monthly date. Action, buy to open. Quantity, 1 contract, 100 shares. Order type, limit. Limit price, $4 even, the mid price. Time in force, day order. You review the order. Maximum loss if Apple falls and the option expires worthless, $400. That is the only number that matters before you submit. You are risking $400 on a thesis that Apple recovers 4% over 6 weeks. The potential gain if Apple reaches 192. The option would be worth approximately $8.20, a profit of $4.20, or 105% return on the $400 investment. You submit the order. It fills at $4 even within 30 seconds. Position open. Step 9. Setting your exit plan before the stock moves. This step is non-negotiable and must happen immediately after entry, not when you are under pressure from a moving market. 2 exits. Exit 1. Profit target. If the option reaches $6, a 50% gain from $4, you will take partial or full profit. If it reaches $8, you will close the full position. You do not need to catch every last cent of the move. A 50 to 100% return on an options position is an excellent result. Exit 2. Stop loss. If the option falls to $2, a 50% loss, you will close the position. The thesis has not played out as expected, and continuing to hold a rapidly decaying position, hoping for recovery, is how small losses become large ones. $2 maximum loss per share, $200 per contract. Written down. Fixed. Non-negotiable. 10 days into the trade. Apple has risen from $182.50 to $188, a $5.50 move. Your option is now worth $6.30. The position is up $2.30, 57.5% in 10 days. Delta has increased from 0.42 to 0.60. Apple is now above your strike. The option is in the money. Theta has consumed approximately 70 cents over 10 days. But the directional gain of $3.60 from Delta and Gamma movement far outweighs the Theta cost. You have 35 days remaining. The thesis is playing out. 3 decisions available. Sell now and lock in a 57% gain. Sell half and let the rest run, or hold the full position toward the $8 target. This is not a textbook question. It depends on your risk tolerance and confidence in the thesis continuing. Step 10. Taking profit. You decide to sell half the position at $6.30, locking in a $115 profit on the half sold, and leaving the remaining half to run toward the $8 target. This is the disciplined approach. You have secured a real profit, reduced your risk, and still have upside exposure. 5 days later, Apple reaches $192.50. Your remaining half contract option is now worth $8.05, just above your full target. You close the remaining position at $8 even. Total result: first half sold at $6.30, profit $115. Second half sold at $8, profit $200. Combined profit on a $400 investment, $315. Return: 78.8% in 15 trading days. Apple moved 9.5%. Your option returned 78.8%. That is the leverage and the risk management that options provide. Now the other scenario, the trade goes against you. Apple drops from $182.50 to $176 over the first 10 days. Negative macro data, broader market sell-off, no company-specific news. Your option has fallen from $4 to $1.80. You are down $2.20, 55%. This is past your $2 stop level. The stop triggers. You close the position at $1.80. Loss: $220 on a $400 investment. Painful, but controlled. You knew before entering that the maximum loss was $400. You never reached it. The stop at 50% worked as designed. The thesis was wrong. The macro headwind did not fade, it intensified. That happens. No trade has 100% probability. The discipline is in closing the losing trade cleanly, preserving capital, and moving to the next thesis with $280 still in your account. The complete trade on one page. Thesis: Apple oversold, macro recovery expected, for the $12 move over 4 to 6 weeks. Direction: bullish, call option. Strike: 185, slightly OTM, delta 0.42. Expiry: 45 days, medium dated monthly. Premium paid: for dollars, total cost $400. Greeks at entry: delta 0.42, theta negative 7 cents per day, vega 0.14, for 22%. Liquidity check: spread 40 cents, volume 1,400, OI 3,892. Order type: limit at $4 even, filled in 30 seconds. Exit plan: profit target $6 to $8, stop loss $2. Win scenario: Apple to $192.50 in 15 days, option sold at $8, profit $315, 78% return. Loss scenario: Apple to $176 in 10 days, stop triggered at 180 cents, lost $220. 8 decisions, all made before the stock moved a single cent. Here is what you now know, and more importantly, what you can now do. 1. A complete options trade has 8 decisions, and every one of them is answerable using what you have learned in this series. 2. The thesis drives direction. Direction drives the instrument. The instrument drives the strike and expiry. 3. The chain confirms your entry. The Greeks confirm your risk. 4. Confirms your timing. 4. The exit plan is set before entry, profit target and stop loss, both fixed, both non-negotiable. 5. Winning trades are managed, not just held. Take partial profit at targets. Let the remainder run. 6. Losing trades are cut at the stop level. Capital preservation is the first rule of staying in the game. That is video 7 complete. From here, the series moves into strategy, the specific setups that professional traders use repeatedly to generate income and manage risk. The next video covers the covered call, one of the most widely used option strategies in the world.